How is it even possible that 99% of traders lose money in a game they voluntarily chose to play? You'd think with all the sophisticated tools, detailed charts, proven strategies, and expensive courses available today, someone would have finally cracked the code. But here's the devastating truth. The game is rigged. Not by secret algorithms or insider information, but by something far more insidious. By you, the trader. Your own psychology is your greatest enemy. Your desperate need to be right. Your craving for instant gratification. Your inability to let go of a losing position. That's what feeds the casino. Because this isn't a marketplace, it's a mirror. And you are not the house. You are the entertainment. Welcome to the casino mirror. A place where smart money plays you like a masterful pianist. Not by predicting market movements, but by predicting your fear, your hesitation, and your greed. Every time you press that buy or sell button, you're not executing a calculated strategy. You're revealing your soul to those who know how to read it. The saddest part? The house doesn't even need to cheat. It simply lets you keep being you. But what if you could stop being the performer and become the architect? What if you could see what the house sees, know what the dealer knows, and trade not like a hopeful dreamer, but like the very force that moves the market itself? In this video, based on brutal truths from a former FX dealer turned insider author, you're about to step into the shadows behind the market curtain. No fluff, no fairy tales, just 20 devastating revelations that will either break you or rebuild you into a trader no one sees coming. By the end, if you're still standing, you won't be playing the game anymore. You'll be designing it. Chapter 1. The mirror doesn't reflect you. It watches you. You're not looking at the chart. The chart is looking at you. Every candle you analyze, every level you mark, every signal you interpret is really just a mirror. And behind that mirror, someone is watching. Not a villain or a hacker, but the house. Smart money. The dealer that doesn't need to bluff because they already know exactly how you think. They don't trade against the market. They trade against your assumptions. Here's the revolutionary concept. The market is not moved by logic or even news. It's moved by behavioral liquidity. This means price is simply the end result of your beliefs colliding with thousands of others, and smart money understands this perfectly. You think you're watching the market, but in truth, the market is testing you. Are you scared yet? Are you buying too early, selling too late, getting greedy after 3 consecutive wins, shrinking after 2 losses? The market sees it all and reacts accordingly. Imagine walking into a casino where every roulette wheel changes odds based on your heartbeat, where every slot machine adjusts payouts when you get hopeful. That's the financial market, alive with your emotional signals. Your emotional leakage becomes their edge. During my time behind the curtain at an FX brokerage, I watched 15,000 accounts struggle to survive. Most didn't make it, but it wasn't because they were unintelligent. They were simply predictable. When charts rose, retail would short. When charts fell, retail would go long. Over and over, the same pattern. It wasn't even manipulation. It was pattern recognition, like playing chess against someone who always opens with the same move. Eventually, you don't even have to try anymore. You just wait for them to fall into their own trap. What this really means is that you're not trading against the market. You're trading against the reflection of every trader just like you. You are the liquidity. You are the trend's fuel. The moment you understand this, you stop trying to outguess price and start outsmarting behavior. So here's your first mirror moment. Have you ever examined your trades and realized they all originated from the same emotional place? Not strategy or logic, but deep emotional reflexes, fear of missing out, hope for revenge, the need to win today to feel worthy. What if that's what the chart has been showing you all along? Not market patterns, but your own patterns. Chapter 2. Why you're designed to lose. Let me hit you with something uncomfortable. You weren't just unlucky when you lost those trades. You were engineered to lose them. Not by your broker or some evil Wall Street conspiracy, but by a much more ruthless architect, your own brain. Here's the truth. Retail traders don't just lose money randomly. They lose it in precisely the same predictable patterns, again and again and again. The devastating reality isn't just that retail loses, it's that they lose exactly how smart money expects them to. Why? Because the human mind is hardwired to trade against profitability. You crave certainty in an uncertain world. You fear loss more than you value gain. You seek to be right instead of rich. You cut winners short and ride losers straight to hell. You see price dropping and think, it has to bounce. You see it rising and think, it's gone too far. But the market doesn't care how far it's gone. It only cares about how many people think it can't go further. Here's the perfect metaphor. Imagine a casino game where the machine reads your nervous system. It waits for you to feel confident, then flips the odds against you. That's exactly how the market treats your sentiment. This is why, according to actual brokerage statistics, 99% of retail traders will never be net profitable long term. Not because the odds are unfair, but because they can't overcome themselves. Let me share what I witnessed. When I worked on the back end of a major broker, I could see it happening live. Thousands of traders reacting identically to the same market moves. Price would spike up, hundreds of short positions would open immediately. Price would dip hard, long orders would flood in like a tsunami. These weren't unintelligent people. Many were using different strategies, but their psychological responses were always the same. Over time, we could predict what was coming. Within weeks, most of those accounts were either wiped out, margin called, or went dormant. The market is a behavioral mirror. It rewards those who act counter to human instinct and punishes those who follow it blindly. That's why smart money can exist, not because they're more intelligent, but because they're more emotionally neutral. They don't need to be right. They need to be positioned correctly. They don't chase perfection, they chase positioning. Have you ever thought, why did I just make that trade? Not how you did it, but why? Was it revenge, boredom, trying to recover the last loss, trying to feel intelligent again after being wrong? That's the code the market is reading. Until you decode this, until you recognize that you are not a rational actor, you will remain part of the 99%. Not because you lack skill, but because you refuse to confront yourself. Here's the beautiful truth. If you're designed to lose, you can also be redesigned to win. But first, you need to understand exactly what smart money is watching for when they observe the herd. Chapter 3, Sentiment, the Invisible Rig. The chart you see is not just price. It's a fingerprint, a behavioral heat map, a confession. Every candle, every wick, every movement isn't just market data. It's sentiment. And sentiment is where the game is truly rigged. Most traders obsess over technicals, indicators, news, and entry setups. But none of that answers the only question that truly matters. Who is trapped? Sentiment analysis is the forgotten discipline because it forces you to look beyond lines and price action into the collective psyche of the herd. If 70% of traders are long, where do you think smart money is positioned? On the opposite side. Always. Because the herd doesn't move the market, the herd feeds it. Imagine walking into a room full of people placing bets. You don't know the game, but you're told that 95 out of 100 people in this room will lose. What would you do? You'd watch the crowd. You'd track their reactions. You'd do the opposite. That's what sentiment indicators reveal. They show you the weight of collective delusion. And that delusion is the signal. When I monitored real-time positioning data from brokers like Oanda, MyFXBook, and FXCM, the patterns were surgical in their precision. When USD spiked up, retail would short even harder. When price dipped, they'd go long even more aggressively. Over and over, the same mistake. Retail assumed price couldn't go further, simply because they didn't want it to. Every time they believed the move was over, smart money knew the move had just begun. Because they weren't trading charts, they were trading retail emotions. Sentiment is the only true edge that survives every market regime. Indicators break, patterns evolve, but herd behavior never changes. That's why sentiment isn't an add-on, it's the core system. It tells you where energy is stacked, where stops are likely to be hit, where liquidity will be taken, and most importantly, who is about to be sacrificed next. Have you ever entered a trade and immediately felt uncomfortable, like the market was watching you? It was, because your trade just became part of the public sentiment flow. What if, instead of reacting to price, you positioned yourself where the crowd would panic into your entry? What if you could finally see the traps, not because you guessed, but because the crowd screamed their location? But this is just the tip of the iceberg. Sentiment shows you the crowd, but what if you could understand the specific behaviors they repeat like a glitch in human nature? Chapter 4. The 1% traders who don't trade like traders. Here's something that should terrify you. The top 1% of traders don't think like traders. They don't chase entries. They don't obsess over indicators. And most importantly, they don't try to beat the market. Instead, they position themselves where you will fail. Their goal is not prediction, it's predation. You imagine smart money sitting in glass towers, using supercomputers and dark pool algorithms to stay 10 steps ahead. That might be partially true, but their real advantage is understanding your patterns. They know how you react when your trade goes red. They know how you average down in denial. They know how you cut profits short and let losses run like bleeding wounds. They design the market to feed off these behaviors. The edge of the 1% is behavioral inversion. They do the things your brain resists. They buy when it feels stupid. They hold when it feels dangerous. They sell when your confirmation bias is on fire. The difference between you and them isn't intelligence. It's emotional immunity. Let me show you how they see the game. USD is rising fast. Retail shorts are piling in, thinking it's overbought. Smart money doesn't care about RSI readings. They care that stop losses are stacking above the last high. That's liquidity. That's food. So, they push price up, not because they believe in your strength, but because they know you'll be stopped out. Then, once your short is liquidated and your pain is at maximum, they reverse. That spike you thought was manipulation, it wasn't manipulation, it was harvesting. At the brokerage, we watched this in real time. Accounts would open short after short into strength, confident that price couldn't go higher. It did, and it always went just enough to trigger the largest cluster of stop losses. Price didn't move on its own. It was dragged by the gravitational pull of herd positioning. Once the weak hands were eliminated, that's when smart money entered quietly in the opposite direction. The 1% don't have magical strategies. They simply think in probabilities, pain points, and herd psychology. They assume you will behave emotionally and build their systems around that assumption. While you chase setups, they chase situations. They trade like predators, calm, calculating, and absolutely ruthless. Ask yourself, have you ever looked at a reversal and thought, why did it turn right after I got stopped out? What if that wasn't coincidence? What if you were part of the liquidity package that triggered the shift? What if your behavior was so common it was baked into the price? The 1% don't just win because they're smarter. They win because they're not you. But what if you could start seeing what they see? What if you could recognize the exact moments when the herd behaves like the herd? Chapter 5. The down move that makes you buy and die. Every time the market crashes, someone says, this is a great buying opportunity. And every time that someone becomes liquidity. You've probably said it yourself. It can't go lower, but it does. And when it does, it doesn't just hurt your balance. It hurts your belief in logic. Because you weren't trading logic. You were trading hope. When price goes down, most retail traders do the most predictable thing. They buy. Not because they see a reversal signal, but because their brain screams, it's too cheap to fall further. But the market doesn't care what's cheap. It cares who's trapped. The deeper price falls, the more retail steps in, trying to catch the bottom like it's a reflex. Picture a black hole. From the outside, it looks like just another dark spot in space. But once you get close enough, you're caught. You can't escape. That's what a downtrend is. It pulls in the hopeful, the stubborn, the ones looking for value. Just like gravity, once you're inside, you don't get out alive. Watching broker sentiment data, we noticed that every strong downtrend was met by increasing retail long positions. The further price dropped, the more people bought. Here's the tragic twist. They weren't wrong about the value, but they were early. And the market doesn't reward early, it punishes it. Traders were averaging down, believing it would bounce, praying for a V-shaped recovery. But the bounce never came. Only liquidation did. Buying into a downtrend isn't strategy. It's surrender in disguise. It's the last gasp of the retail ego, unwilling to admit it's wrong. It's desperate hope that the market will turn just to validate a decision you already made emotionally. Smart money waits patiently. They let you dig your own grave, one long order at a time. Pause and look inward. Have you ever seen a red candle and thought, this is the bottom? Did you buy not because your system said so, but because you needed it to go up? That's not analysis. That's a silent prayer. The market is not God. It doesn't answer prayers. It answers pressure. When enough long traders stack their hopes at the bottom, smart money collects the stop-loss offerings like a ritual. But this is just one half of the herd's doom loop. Because if you buy into falling markets, guess what you do when price is rising? Chapter 6. The rise that makes you short. There's a strange moment in every trader's life when they look at a chart going straight up and whisper, there's no way it goes higher. Then they hit sell, and then it does go higher and higher until the screen bleeds, until stop losses explode, until the trader mutters, this market is rigged. But it isn't rigged, it's just responding to you. Most retail traders short into strength, not because of data or trend structure, but because the human mind hates momentum. We crave gravity. We believe what goes up must come down because that feels balanced. But the market doesn't follow gravity. It follows liquidity. The faster price moves up, the more shorts get caught, and the more fuel gets poured on the fire. Imagine a hot air balloon rising slowly. You think it's safe to throw a rope on it and pull it back down. But the more people who grab the rope and try to pull it down, the higher it goes, carried by the pressure of all those trying to stop it. That's what an uptrend is. It's not floating on fundamentals. It's fueled by the pain of your disbelief. Inside the broker logs, we saw it play out endlessly. GBP/JPY surging, retail shorts piled in like ants to a flame. Resistance levels marked with confidence, as if price respected their drawings. But price didn't care. It moved higher. Not because it was overvalued, but because every new short was a buy order waiting to be triggered. Smart money loves nothing more than retail sellers trapped in their own arrogance. Smart money doesn't push price up because they're bullish. They push it because they know you're bearish. The goal isn't movement, it's reaction. Your need to be right, to call the top, is their invitation to extract liquidity from your margin. Look in the mirror. How many times have you shorted a strong uptrend thinking you were smarter than the crowd, only to realize you were the crowd? How many divergences have you trusted, only to see them diverge straight through your account? You weren't trading reversal. You were trading revenge. Every time you short an uptrend and it pulls back slightly, you think you were right, so you double down next time. Until one day, it doesn't pull back. It doesn't stop. Then you're not just wrong. You're liquidated. But this pattern isn't limited to emotional entries. It infects your entire system design. Because most retail strategies are built to feel right in the short term and collapse in the long run. Chapter 7. The painful truth about range trading. Let me tell you something. Wall Street will never tattoo on your trading station. The market ranges until it kills. That tight little sideways dance that makes you feel clever. That safe zone where you collect small, consistent profits. It's a trap. A soft-spoken trap that whispers, "See, you're good at this." Until one day, it doesn't whisper anymore. It screams and takes everything back. Most retail strategies are mean reversion-based, meaning they rely on the assumption that price will return to the average. Buy low, sell high, fade extremes. It works until it doesn't. Because the market doesn't reverse because it's supposed to. It reverses when the crowd is overexposed and their liquidation creates the opposite move. Think of the range market like a fishing pond. You cast out your net, catch a few minnows, feel confident. You get used to it. You fish every day, you bring others. Then one day, without warning, the pond drains, and you realize you weren't the fisherman. You were the fish farmed for confidence until the real predator came. When I monitored sentiment flows, I saw this play out hundreds of times. A trader wins 9 trades in a row in a ranging market. They become bolder, increase lot size, reduce stops. Then a breakout happens, a strong trend driven by real macro liquidity. But the trader keeps fading it, thinking, it'll come back, it always comes back. It doesn't. Margin call, account gone, months of gains erased in hours. The reason retail loves sideways markets is because they validate poor habits. They reward early entries. They forgive lack of stop losses. They make over-leveraging look smart. They reward the wrong behaviors just long enough to ingrain them into your muscle memory. Then the market turns, and those habits destroy you. How many times have you felt in the zone because your small trades kept hitting profit? Did you ever think, I've finally figured it out? That feeling isn't mastery. That's seduction. That's the dealer letting you win just enough to keep playing. Right before the breakout, when you increase your size, that's when the table turns. Range strategies aren't the disease. Your misunderstanding of risk is. And when the sideways lull ends, the trend begins with a vengeance. Chapter 8. The house never buys high or sells low, you do. Have you ever wondered why your trades feel perfect when you place them, but feel foolish seconds later? You short right after a strong candle up. You go long just after a wicked flush. The market seems to know. It doesn't move immediately. It waits. Then it turns. Not against logic, but against you. The market is designed to maximize liquidity, not fairness. The highest liquidity is almost always stacked where your emotions are strongest. Right after price breaks a level and you jump in, that's where smart money waits. Because that's where you're most vulnerable, most certain, most exposed. Picture a grocery store that rearranges its aisles based on your hunger. Every time you crave sugar, the sweets are harder to reach. When you're dieting, the cookies are on sale. You feel like you're making choices, but the environment is making them for you. That's how the marketplace is priced. It lets you reveal your intentions, then shifts the shelves. Analyzing the back end of order books from platforms like Oanda and FXCM, here's what we saw. Above resistance, clusters of buy-stop orders, retailers trying to catch a breakout. Below support, swarms of sell stops, hoping to break down with the trend. But in reality, these aren't momentum zones. They are liquidity zones. Smart money uses them like fishing nets. For example, USD rallies toward a clean resistance line. Retail traders wait for confirmation. The candle breaks through. They buy. Price hesitates, then reverses. Why? Because the breakout wasn't real. It was a liquidity grab. Smart money pushed price into the cluster of buy stops, sold their longs into your momentum, and left you holding the top. The house never takes a trade when it feels right, and they take it when you can't imagine doing it. They don't buy because price is low. They buy because you just sold. They don't sell because it's high. They sell because you just bought. Their actions aren't chart-based. They're counter-behavioral. Pause and look back. How many of your entries came after you felt a sense of confirmation? How many times did you think, now it's safe? That moment of safety was the trap, and that trap was laid long before you clicked buy. You're not trading levels. You're trading expectation. Every expectation the herd shares becomes a feeding ground for the few who don't think like traders, who don't chase breakouts, who don't react to price, but who place themselves calmly on the other side of your urgency. Now that you see how the house takes your trade and flips it, let's dive into what truly matters in your system. It's not your entry, it's something else entirely, something most traders ignore until it's too late. Chapter 9, Why Your System Isn't Failing. Your exit is. You've probably spent months, maybe years, perfecting your entries, backtesting, watching countless indicators, waiting for the perfect setup. But here's the painful truth. Entries don't make you profitable. Exits do. And the reason you keep losing isn't your system. It's the way you leave the trade. The financial markets are a playground of expectation and emotion. Your entry is just the handshake. Your exit, that's the negotiation of who gets paid. Most traders, especially retail, exit from fear, not strategy. They take profits too soon, let losses run too long, or worse, move stop losses to avoid pain. Imagine you're in a burning building. You see the exit sign, but instead of running out, you keep rearranging the furniture, trying to make the loss look better. That's how most traders deal with exits. They don't escape, they delay. And in doing so, they get burned. Watching trader dashboards, we saw a shocking pattern. The majority of retail trades were closed with profit. Sounds good, right? But those profits were small, tiny. Meanwhile, the losing trades were massive, catastrophic. Why? Because when retail traders win, they want to lock it in. But when they lose, they hope it'll turn around. That hope grows, the loss deepens, the exit never comes until the margin call does. A system is only as strong as your worst exit. The illusion that your win rate defines your edge is a deadly lie. Some of the greatest traders in the world win only 30–40% of the time, but they let those wins run like wild horses. And they cut their losses like surgeons, clean, fast, precise. Here's true trader exit logic. You're not there to feel safe. You're there to execute. Your stop is not a suggestion. Your profit target is not an ego boost. It's all math. Because the market isn't a battle of strategies. It's a battle of distribution. If your system has a 2.1 reward-to-risk ratio, your only job is to stick to it. Emotion-free. No adjusting, no tweaking, no, just this time. Hold the mirror. Have you ever taken profit just because your trade went green and you were scared it'd reverse? Have you ever refused to close a loss thinking, it'll bounce? What if those two behaviors, those two exits, are why your system isn't working? Not because it's flawed, but because you keep interrupting it. If exits matter more than entries, why do traders obsess over signals and setups? What drives that obsession? The answer lies in the myth that's been sold to you, the lie of the perfect system, and the dangerous pursuit that keeps you stuck in the 99%. Chapter 10. The Holy Grail that doesn't exist. You've been hunting it, that perfect system, the strategy with the golden ratio, the indicator combo that never loses. Maybe it's a secret algorithm. Maybe it's price action purity. Maybe it's hidden in a $997 course. But what if I told you it doesn't exist? Not because it hasn't been discovered, but because the very idea is a lie. There is no system immune to human emotion. You could have a strategy that wins 80% of the time, with perfect backtests, AI optimization, and quantum math, and still lose. Why? Because the second fear creeps in, you'll exit early. The moment revenge kicks in, you'll over-leverage. The minute the strategy has 2 losing trades in a row, you'll doubt it, tweak it, abandon it, break it. Not because it stopped working, but because you couldn't handle uncertainty. Imagine a surgeon with the best tools in the world, robotic precision, $1,000,000 instruments. But his hands shake, his heart races. He can't make the cut. That's the retail trader. Brilliant tools, broken nerves. During my time inside trading circles, I met dozens of traders with solid systems. Some used indicators. Others were purely price action. Some scalped. Some swing traded. But the results were eerily consistent. Those who followed their system with discipline thrived, even if the system wasn't amazing. Those who abandoned their plan emotionally failed, no matter how brilliant the setup. You're the magic, and also the weakness. The Holy Grail is not a strategy, it's a mindset. It's the ability to lose without unraveling, to win without getting arrogant, to follow rules when chaos is screaming at you. The system, that's just a hammer. The psychology, that's the hand that swings it. Think about the last time you changed your system. Was it because it stopped performing, or because you couldn't handle the drawdown, the boredom, the feeling of being wrong? Have you ever added an indicator mid-trade, shifted your stop loss on a whim? That's not strategy. That's sabotage disguised as optimization. What if the thing you've been searching for, the perfect system, isn't out there? What if it's a decoy, a delay tactic? What if the true grail is consistency over brilliance? If the perfect system doesn't exist, then what does? How do smart money traders make decisions in real time without the fairy tale? The answer lies not in tools, but in how they interpret the herd. Chapter 11. Media Headlines. The puppet strings of the herd. Every trader thinks they're informed. They wake up, open Bloomberg, scroll through CNBC, check Reddit threads. Headlines scream, market plunges on Fed fears, or stocks surge on tech optimism. It all feels so real, so urgent, so logical, but the market doesn't move on logic. It moves on expectation. And headlines? They're just the post-game commentary of a match already played. Media doesn't predict the market moves, it explains them. By the time they explain it, the move is over. Worse, the herd has already reacted. You're not trading information, you're trading reaction to information. And guess what? That reaction is being used against you. Imagine a magician who tells you what trick he's about to do, after he's already done it. That's the media. They don't publish headlines to inform you. They publish them to reflect what the majority already believes. If the majority believes something in the market, you can bet smart money is preparing to do the opposite. I remember watching this live. In early 2020, headlines started screaming about oil collapse. Oil to zero was the media chorus. Retail did what they always do. They shorted the panic. But smart money was already buying, quietly. While retail sold the bottom, smart money built positions. Weeks later, oil exploded upward. The media changed its tune. Oil recovery shocks traders. But it didn't shock smart money. It was their plan all along. Media is not your edge, it's your leash. The more emotionally you react to headlines, the more predictable you become. The market is a machine designed to harvest predictable behavior. Nothing makes your behavior more predictable than fear and hype delivered in bold font. Look in the mirror. How many trades have you taken based on something you read? A news spike? A Twitter trend? A YouTube forecast? Did you feel like you were in the know? Did the trade go the way you expected, or the opposite? What if the news didn't trigger the move but baited you into it? Smart money reads the same headlines, but they read them like poker players read tells. They don't ask, what does this mean? They ask, how will the herd react to this? Then they position accordingly. The news is not noise, it's signal, but only if you're using it to map behavior, not price. This brings us to one of the most dangerous illusions in trading, the belief that high win rate systems are safe. The pursuit of being right most of the time can be the very thing that ensures you lose it all. Chapter 12, The Lie of High Win Rate Systems. Everyone wants to be right. It feels good. It feels powerful. It feels like control. That's why so many traders chase high win rate systems. Strategies that promise 80%, 90%, even 95% success rates. It sounds like the dream. Win almost every trade, grow slowly, retire rich. But in reality, these systems are time bombs. Slow, silent, and devastating. High win rates come at a deadly cost. Risk exposure. They often rely on small profits, massive stop losses, and systems that work until they don't. When they fail, they don't just dent your equity, they obliterate it. Because the psychology of high-win systems is built on avoidance, avoiding losses, avoiding discomfort, avoiding reality. Imagine walking across a frozen lake. Each step is safe. Each step builds confidence. But unknown to you, the ice is thinning. Your belief in safety is rising, right as the danger beneath you grows. That's a high win rate system. It lulls you into complacency. Then one event cracks everything open. Inside brokerage data, we saw it over and over. Grid systems, Martingale methods, cost averaging strategies, all designed to never lose. They did win. 10 trades, 50 trades, 100 trades. Then came the outlier. The one move that didn't reverse. The trend that didn't end. The account blew up in minutes. Not from slippage, from belief. The belief that small wins could mask giant risks. Trading is not about being right often. It's about being positioned correctly when it matters. A trader with a 30% win rate can outperform someone with 90% if their risk-reward is asymmetric. It's not how often you win, it's how big you win when you do, and how small you lose when you're wrong. Have you ever found yourself cutting trades early just to lock in green? Have you ever added to a loser because it always bounces? Do you take pride in win streaks but avoid talking about that one trade that wiped you out? That's not strategy. That's emotional camouflage. And the market sees through it. The more obsessed you are with being right, the less power you have. Because you'll avoid trades that feel risky, even if they have high reward. You'll hold losers too long to protect your ego. You'll exit winners too early to feel good. All of it keeps you in a cycle where you're not trading probabilities. You're trading identity. But this sets the stage for one of the most controversial truths in all of trading. Stop hunting is real. Your carefully placed stop loss may actually be the invitation smart money's been waiting for. Chapter 13. Stop hunting isn't a myth, it's a tool. You've heard the whispers. They hunted my stop. It reversed the second I got out. The market knows where I place my SL. Maybe you laughed it off. Maybe you thought, that's just paranoia. But here's the truth. Stop hunting is not a conspiracy theory. It's a feature built into the system by design. Smart money doesn't hunt your stops to spite you. They hunt them because they're fuel. Stop-loss orders are pending market orders. When price hits them, it triggers buying or selling activity. That's liquidity. Liquidity is what institutional players need to enter or exit massive positions without slippage. They can't just buy or sell in silence. They need volume, and your pain provides it. Imagine a lion stalking a herd. The lion doesn't attack randomly. It waits for the herd to clump together. Panicked, predictable, exposed. That's your stop. A cluster of weakness, a flashpoint of emotional surrender. When enough stops are stacked beneath a level, the lions feast. I've seen the data. I've worked inside systems that mapped retail orders in real time. I know where 80% of traders place their stops, just below support, just above resistance. Just far enough to feel safe, but close enough to be harvested. The market doesn't guess where you'll give up. It knows. Because retail sentiment isn't hidden, it's shared across platforms, aggregated, packaged, sold. Your stop isn't private, it's public knowledge. Stop hunting isn't about you, it's about efficiency. Smart money doesn't care about punishing you, they care about getting filled. Where better to enter a long position than after a massive flush downward triggered by thousands of stop losses? Where better to sell than just after retail longs get stopped and price spikes from panic entries? Have you ever had a trade barely hit your stop, only to watch it reverse immediately after? Did you move your stop just a bit further the next time? Or worse, did you remove it altogether? That's the real hunt. Not your order, your psychology. Once the market gets you to doubt your discipline, it doesn't need to stop you out. You'll self-destruct. What if you placed your stop not where it feels safe, but where it looks stupid? What if safety isn't just distance from entry, but visibility to the herd? Because the more your stop looks like everyone else's, the more likely it is to become bait. But if stop hunting is the invisible knife, What happens when you mix it with another weapon? One that promises consistent profits, fast growth, and never loses until it collapses everything? Next, we dive into one of the most seductive systems ever invented and the hidden death spiral it creates. Chapter 14, the Martingale Death Spiral. It starts off innocent, one small loss, then another. But you have a secret weapon, doubling down. If I increase the size, you tell yourself, I only need one win to make it all back. And so you do, and it works, until it doesn't. And when it doesn't, it erases everything. Welcome to Martingale, the strategy that flatters your ego, feeds your greed, and feasts on your soul. Martingale is not a trading strategy. It's a slow-motion execution. The concept seems brilliant. After every loss, you double your position, so the next win recovers everything. But what traders forget is this. Markets can remain irrational longer than your account can remain funded. Imagine walking into a casino with a suitcase of cash. You bet $10 and lose, then 20, lose, then 40, lose again. Each time, your hand shakes, but you believe, one win and I'm out. But the table doesn't care. The table waits. It can break your spirit in 6 rounds. Not because it's rigged, but because your belief is. In the broker data, Martingale accounts were like lit candles in a wind tunnel, beautiful for a while, then gone in a flash. We watched as traders doubled, tripled, quadrupled exposure. They looked like geniuses during quiet markets. Small, fast wins, confidence soared. Then a trend emerged. Price moved steadily, mercilessly, without pullback, 10 steps against them. By step 11, obliteration. Martingale strategies punish you for being human. They make you feel in control. They reward your impatience. They weaponize your fear of loss and your addiction to just one more win. The worst part, they work until they ruin you. Have you ever increased your position after a loss? Not because of setup strength, but to chase recovery? Did you feel a high when you finally made it back? That high is the drug. Martingale isn't about math. It's about emotion addiction, the rush of redemption, the illusion of control. Like all addictions, it ends in collapse. What if the next time you feel the urge to double down, you paused and asked, am I trading a setup or seeking salvation? Because the difference between mastery and meltdown isn't logic. It's discipline under pressure. But there's one more piece to this death spiral. It's not just the strategy, it's when traders use it. Because Martingale feels safest in calm markets, ranging markets. And ranging conditions don't just lure you in, they train you to self-destruct when volatility returns. Chapter 15. When ranging markets train you to die in trends. It's quiet, the candles drift gently, a few pips here, a few pips there. You enter, it goes your way, again and again. The market feels like a soft rhythm, a song you've learned to dance with. You start increasing size, lowering your guard. I've mastered this, you think. But you didn't master the market. The market trained you for slaughter. Ranging markets don't just deceive, they condition. They teach you to cut corners, to override your system, to over-leverage. They let you be sloppy and still win. That's the trap. Because when the trend finally comes, and it always does, you'll be standing there, bloated with false confidence and overexposure, right in front of a freight train. Think of a tranquil sea. You sail gently, day after day. No storm, no waves. You toss the life vest aside. I don't need it anymore, you say. Then one day, the sky goes black. The winds change. In one wave, the ocean reminds you. It was never safe. You were just lucky. Inside brokerage logs, ranging markets were where most traders built their worst habits. Traders would fade tops and bottoms, take counter-trend trades with no stop, martingale their way through every minor pullback. Because it worked, 10, 20, even 50 times, they believed it was skill. But the moment volatility returned, the strategy wasn't just invalid, it was fatal. Markets don't reward intelligence, they reward discipline. Ranging markets punish discipline by making recklessness feel effective. But when the breakout comes, only the disciplined survive. Because the market doesn't need to beat you, it just needs you to beat yourself. Be honest, have you ever felt invincible during a low volatility phase? Have you ever thought, this is too easy? Did you add more size, remove your stops, trade out of boredom? That wasn't progress. That was programming. You were being trained to fail in motion. What if you treated every range market as if a breakout could come at any second? What if your position sizing, your stop-loss logic, your risk management never changed, regardless of price behavior? That's not caution. That's survival. In this game, survival is the edge. But there's a deeper reason traders lose themselves in ranges and die in trends. It's not just strategy or structure. It's something darker, something most traders carry like a shadow, the emotional need to be in control. And that need is what smart money plays like a violin. Chapter 16. Control is an illusion and your greatest weakness. Every trader secretly craves it. Control, the ability to dictate outcomes, to bend charts to will, to outsmart the market, prove something to someone, and silence that inner fear. But here's the truth. You don't control the market. You barely control yourself. Every time you try to control the chaos tightens its grip. Trading is not about control. It's about alignment. The market is a storm, a current, a wild animal. You don't tame it. You ride it. When you stop trying to predict, force, or manipulate outcomes, and start reading the emotional wind, that's when everything shifts. Imagine standing in a river. You can either swim with the current or fight it. Most retail traders spend their entire careers trying to dam the river with their logic, their indicators, their beliefs. But the water doesn't care. It flows around, through, and eventually over them. The successful trader, he steps into flow and lets go of control. In brokerage data, we saw a painful trend. The traders who micromanaged everything, manually closed trades early, constantly adjusted stop losses, moved take profits just in case, were also the ones with the least consistent results. Why? Because they weren't trading systems. They were trading emotion dressed up as analysis. Control is the enemy of consistency. The need to feel in control leads to behaviors like overtrading, revenge trading, ignoring rules, and impulsive decision-making. The market has learned to bait that need. It gives you a few wins, just enough to make you believe you've mastered it. Then, snap, it turns. Every ounce of control you thought you had evaporates like mist. Have you ever exited a trade not because it hit your plan, but because you couldn't take the pressure anymore? Have you moved your stop loss wider to let it breathe, only to bleed out? That wasn't strategy. That was fear dressed as finesse, and it cost you everything. What if the goal was never to control the market, but to control how little you interfere with your edge? What if real power wasn't found in micro decisions, but in trusting your system when everything inside you screams not to? This realization separates amateurs from professionals. Amateurs seek to master the market. Professionals master themselves. They know that when emotion rises, clarity falls. The second you try to impose control is the moment the market reclaims it. But this illusion of control has a cousin, an equally destructive force that wears the mask of ambition: overtrading, the compulsive need to always do something, to be active. Chapter 17. Overtrading, the addiction disguised as dedication. It starts with a small win, then another. The dopamine hits. Your hands move faster. You're in sync. I'm on fire today. You think, one more trade, then one more, and another, until suddenly the market turns and all the gains melt away. What happened? You weren't trading anymore. You were chasing a high. Welcome to the most common killer of retail accounts: overtrading. Overtrading is not ambition. It's emotional leakage. It's what happens when your sense of enough is broken. You trade to feel in control, to avoid boredom, to make back what you just lost, or to milk a winning day. Either way, the root isn't strategy, it's addiction. The screen becomes a slot machine. The mouse, your lever. Imagine a boxer who keeps swinging long after the bell has rung. He's not fighting the opponent anymore. He's fighting his own ego. That's the trader who can't stop clicking. He's no longer in the zone. He's in the spiral. From the broker's side, we saw it like clockwork. A trader wins 3 trades in the London session. Instead of stepping back, they re-enter. Then again. And again. By the time New York opens, they've taken 15 trades. The edge is gone. The emotional capital, drained. The account, dying not from one big mistake, but from 1,000 cuts. You're not just trading your edge. You're trading your energy bandwidth. Every decision, every click, every reaction drains your clarity. Overtrading isn't a time issue. It's a signal issue. The more you trade, the more diluted your signals become, until you're just reacting to motion, not method. Have you ever looked back at a full day of trades and thought, I didn't need half of these? Have you ever felt the impulse to trade just because the chart moved? Not because it met your criteria? That's not discipline. That's compulsion. The market loves a compulsive trader because they're predictable, and profitable for the other side. What if you measured success not by how many trades you took, but by how few unnecessary ones you allowed? What if your real edge wasn't in doing more, but in doing less with more precision? This leads to a deeper question. Why do traders overtrade? What are they running from? In many cases, it's not greed. It's fear. Fear of missing out. Fear of boredom. Fear of sitting with themselves. Chapter 18. FOMO, the virus that trades for you. The chart moves. Fast. It's breaking out. You weren't ready, but you feel it. The panic. The urgency. If I don't get in now, I'll miss it. Your hand twitches toward the mouse. Your rules blur. You jump in. Seconds later, the move ends. You're trapped. Again. Not by the market, but by your own mind. That's not a trade. That's FOMO trading, and it owns you. FOMO, fear of missing out, is the market's most powerful psychological weapon. It doesn't need charts or indicators. It only needs one thing: your belief that opportunity is scarce. When that belief kicks in, it hijacks your logic, your system, your process, and replaces it with a single command: act now or regret forever. Imagine a lifeboat leaving the dock. You miss the signal. The crowd is boarding. You see them go. Suddenly, it doesn't matter if you have a plan. You leap. You don't check your shoes. You don't ask if you're supposed to be on that boat. You jump just to avoid being left behind. That's every FOMO trade. It's not analysis. It's emotional survival mode. From the broker's seat, I watch traders get destroyed by this impulse. News breaks, a breakout happens, one candle, two, momentum builds. Retail traders flood in, not because of signals, but because they can't bear the thought of watching a winning trade without them in it. They enter late, get caught in the pullback, slippage hits, stop-loss fires. They blame manipulation. But the real manipulation, it happened inside. FOMO is not about the market moving without you. It's about your need to belong to the move. That need doesn't come from logic. It comes from fear, from insecurity, from ego. Smart money knows it. They engineer FOMO. They build fake breakouts, manipulate volume, use news releases like emotional grenades, all to make you move first so they can act second. How many times have you entered a trade, not because of confirmation, but because it's going without me? How many times did you win those trades long term? Did they help your system or break it? What if missing a trade was part of your edge? What if inaction is the greatest flex of power in a world that glorifies speed? The best traders don't chase, they wait. They know that real setups return. The market is not a one-time lottery. It's an infinite game, and only those who can resist urgency last. But FOMO has a twin, a dark reflection. Not the fear of missing out, but the refusal to let go. The most devastating emotion in trading, hope, the kind that keeps you in losing trades, praying for a miracle, while your account bleeds out beneath you. Chapter 19. Hope, the slowest way to die. You enter a trade. It turns against you, just a little. It'll bounce, you whisper, then more red. You check the higher time frame, draw new lines. It's just a pullback. More pain, more waiting. You lower your stop or remove it. This can't go much lower. By the time you realize the truth, you're already underwater, not just in equity but in delusion. This isn't trading anymore. This is hope holding, and it's fatal. Hope is the emotion that keeps losing trades alive and profitable ones cut short. It doesn't just blind you, it binds you. It wraps itself around your ego, your identity, your pride. It whispers, just give it a little more room. It'll turn. But the market doesn't turn because you need it to. It turns because of pressure. When the only pressure is your desperation, you become the liquidity. Hope is like a slow leak in a submarine. You don't notice it at first, just a few drips. Then the air gets thinner, the lights dim, you tell yourself it's fine. Until the pressure builds and the vessel cracks. That's what hope does to your trades, quietly, consistently, until collapse is the only option left. From my time inside brokerage sentiment flows, the most heartbreaking charts were the ones with retail trapped in long positions, hoping for reversal, even as the trend grew stronger. Retail held, they added, they refused to exit. The drawdowns deepened. When the stops finally hit, or the margin calls came, it was all over. Not because they had a bad system, but because they couldn't let go. Hope is a form of self-betrayal. It seduces you into staying loyal to a bad decision just because you made it. It traps you inside your own ego loop. Worst of all, it feels good. It feels noble, like strength. But it's not strength. It's avoidance wearing a mask. Have you ever stayed in a trade long after your rules told you to exit? Did you rationalize it, redraw your levels, zoom out to make the loss look smaller? That wasn't analysis. That was emotional survival. Every time you do it, you teach your brain that rules don't matter. Only feeling better does. What if you viewed exits not as losses, but as escapes? What if your ability to cut a trade quickly, cleanly, without apology, was your greatest advantage? Because in this game, survival isn't about conviction. It's about flexibility under fire. And now we reach the final deception, the one that combines fear, hope, greed, and pride into one last tragic move, the revenge trade. Chapter 20, Revenge Trading, the Final Blow. The loss stings. It wasn't just money. It felt personal. You stare at the chart, fists clenched. "I'll get it back," you mutter. You widen your lot size. No setup, no plan, just raw emotion and a need to win. You click, you're in. But you're not trading anymore. You're fighting. And the market? It's not your opponent. It's the mirror showing you the truth. You've already lost. Revenge trading is not a strategy. It's an emotional hemorrhage. It's the point where trading becomes warfare. Not against the market, but against your own ego. You no longer care about setups or statistics. You care about justice, about proving you're not a loser, about restoring the story in your head where you're still in control. Imagine a swordsman who loses a duel. He storms back into battle, bloodied, irrational, fueled by rage. He's swinging wildly now, not with precision, but with pain. He doesn't see the traps. He doesn't feel the fatigue. He's blinded by the need to avenge a wound that only he can feel. In trading data across every major platform, the most damaging trades weren't the original losses. They were the ones that followed. The oversized, underplanned, emotionally driven entries meant to get it back. These trades often came minutes after a stop-out. No time for review, no pause, just rage in motion. 9 out of 10 times, they ended not in recovery, but obliteration. Revenge trades aren't about recovering capital. They're about recovering identity. When a trader feels humiliated, exposed, or wrong, they don't seek profit. They seek redemption. That mindset doesn't sharpen edge. It destroys it. Have you ever taken a trade just to make back what you lost? Did you feel it in your chest, the heat, the urgency, the defiance? Did you convince yourself that this one would turn it around? When it didn't? Did you spiral deeper? That's not bad luck. That's emotional sabotage. What if the most powerful decision after a loss is to walk away? What if not trading is the greatest display of strength in a game designed to weaponize your emotion? The pros don't avoid losses. They avoid emotional momentum. They know the fastest way to compound pain is to try and cancel it with action. Revenge trading is the final trap. It's where all bad habits converge. If you survive it, if you catch it before it detonates, then you've passed the hardest test of all, mastering your response to defeat. But how do you build the mental armor to resist all of this? The illusions, the emotional traps, the lies your mind tells you when money's on the line? The answer lies not in the charts, but in how you train your trader's psychology. And that, dear trader, is the mirror we'll return to, over and over. Call to action. The mirror never lies. You've made it through the 20 doors of deception. You've seen how the market doesn't just test your strategy, it tests your soul. Every chapter wasn't just about entries or exits. It was about you, the trader behind the screen, the one no indicator can measure, the one every system rises or falls upon. Let's recall the truths you've now absorbed. You learned that the market is not a machine of fairness. It's a mirror of your emotion. That entries don't make you rich, exits do. That the perfect system is a myth, and your obsession with control is a leash, not a sword. You saw how sideways markets seduce you, how hope bleeds you, how FOMO whispers lies, how revenge trading buries you. And beneath it all, you discovered the real enemy is not them. Not the broker, not smart money, not the news. It's the illusion you carry within. So here's your moment of power. You can walk away from this video and say, interesting ideas. Or you can look into the mirror and ask, which of these traps have I walked into? Which am I still trapped inside? Because the market won't change, but you can. Leave a comment below. What was your biggest aha moment in this journey? Which chapter hit hardest? Let's create a space where traders don't just share strategies, but shed illusions. That's how we grow. Subscribe, because the next video will shatter another layer of lies. If this hit you in the gut, share it with one trader you care about, one person who might be walking blind into the same traps. And remember, the market is a mirror, but only the brave dare look long enough to change what they see.